Good day, everyone. In today's video, we're going to talk about something that might genuinely be the reason you're still struggling to become profitable. And the funny thing is, it might not be your strategy. It might not be your psychology. It might not even be your analysis. It might simply be where you're placing your stop loss. Now, I know that sounds strange because most traders spend months learning entries. They spend months learning market structure, fair value gaps, liquidity sweeps, order blocks, and all the fancy concepts. But despite learning all of that, they still keep getting stopped out. And then what happens? Price immediately goes in the direction they originally anticipated. If you've ever looked at a trade and said, "I was right on the direction, but I still lost the trade," then this video is for you. Because today, I'm going to show you why stop loss placement is one of the most overlooked skills in trading, and how placing your stop loss incorrectly can completely destroy an otherwise profitable strategy. So let's get into it. The first thing you need to understand is this. A stop loss is not there to maximize your risk to reward ratio. Let me say that again. A stop loss is not there to maximize your risk to reward ratio. A stop loss is there to invalidate your trade idea. And this is where most traders make a mistake. They see a beautiful setup. They see a fair value gap. They see a liquidity sweep. They see a market structure shift. And immediately they start calculating how they can get a 1 to 5, 1 to 8, or even a 1 to 10 risk to reward ratio. So what do? They start tightening their stop loss. Instead of placing the stop loss where the trade idea becomes invalid, they place it wherever it gives them the biggest reward. And that is usually where the problems begin. Because the market does not care about your desired risk to reward ratio. The market only cares about liquidity. Price naturally expands. Price naturally retraces. Price naturally sweeps liquidity before making its intended move. And if your stop loss is not sitting exactly where it should be sitting, there is a very high chance you are going to get taken out. This is why many traders get stopped out before the move happens. Now let's talk about something extremely important, the concept of invalidation. Because this is where your stop loss should actually go. When you're buying, your stop loss should generally be below the swing low that validates your bullish idea. Why? Because if price breaks that swing low, the idea you're trading may no longer be valid. When you're selling, your stop loss should generally be above the swing high that validates your bearish idea. Again, because if that swing high gets violated, your original trade idea may no longer be valid. Notice the difference. We're not placing the stop loss based on reward. We're placing it based on logic. We're asking ourselves one question. At what point would I admit that my trade idea is wrong? That point is where your stop loss belongs, not where the biggest risk to reward ratio exists. Now let's take this a step further. Even after identifying a proper invalidation point, there is another mistake traders make. They place the stop loss exactly at the swing point. Exactly. No room, no buffer, no breathing space. And this can become a problem. Because the market doesn't always respect exact levels. Sometimes price will slightly trade through a level before moving in the anticipated direction. This is why I personally like adding a small buffer beyond the invalidation point. Now, the exact size of that buffer depends on the pair you're trading and the time frame you're using. I'm not going to tell you there is one magic number, because there isn't. But the concept remains the same. Give the trade enough room to breathe. The goal is not to survive every manipulation. The goal is simply to avoid getting stopped out by normal market noise. Now let's talk about risk to reward ratios, because this is another area where traders unintentionally sabotage themselves. There is absolutely nothing wrong with wanting a good risk to reward ratio. In fact, having a favorable risk to reward ratio is one of the things that helps traders remain profitable over the long term. But your risk to reward ratio should be determined by what price is actually giving you, not by how much you can tighten your stop loss. What do I mean by that? Before entering a trade, you should already have a logical draw on liquidity or a logical target in mind. You should already know where you expect price to go before it potentially reverses, consolidates, or reacts. Now, if that target naturally gives you a 1-to-2 risk to reward ratio, that's perfectly fine. If it gives you a 1-to-3, that's fine. If it gives you a 1-to-5, that's fine. If it gives you a 1-to-10, that's also fine. The point is that the market should determine the risk to reward ratio, not your desire for a bigger number. Another approach that many profitable traders use is having a fixed risk to reward ratio for every trade. For example, some traders always target 1-to-2, while others always target 1-to-3. There is nothing wrong with that either. Both approaches can work. The problem starts when traders begin manipulating their stop-loss placement simply because they want a larger risk-to-reward ratio. They see a setup that realistically requires a 20-pip stop-loss, but they reduce it to 8 pips just so they can get a bigger reward. And what happens? The setup itself was good. The analysis was good. The direction was correct. But the stop-loss was unrealistic. So the trade gets stopped out before the move happens. This is one of the biggest mistakes traders make. Never sacrifice proper risk management just to make your risk-to-reward ratio look better. Protect the trade first. Place the stop-loss where the trade becomes invalid. Then let the market determine whether that trade gives you a 1-to-2, a 1-to-5, or even a 1-to-10. Because at the end of the day, a realistic 1-to-2 that wins consistently is far better than a forced 1-to-10 that constantly gets stopped out. Now let me give you a reality check. Most traders have had trades where price stopped them out by a few pips, then immediately ran to their take-profit target. You've probably experienced it yourself. You enter. Price moves slightly against you, takes out your stop-loss, and then rallies exactly where you expected. At that moment, most traders think their analysis was wrong. But sometimes the analysis wasn't wrong. Sometimes the stop-loss placement was wrong. And that distinction is extremely important. Because once you understand it, you stop obsessing over finding perfect entries and start focusing on protecting good trade ideas. And actually, this brings me to something important. A lot of traders learn liquidity, fair value gaps, and market structure individually, but they never learn how to combine these concepts together into one complete trading model. And that is exactly why I created the Smart Money Secrets ebook. Inside the book, I break down the core smart money concepts and show you how to combine them together into profitable trading strategies. So if that's something you're interested in, you can get a copy through the first link in the description. Now let's continue with the video. Now let's go to the charts and I'll show you a few real examples where proper stop-loss placement made all the difference. So this trade was one of the trades I took on Friday, and it's actually one of the main reasons why I wanted to create this video. But before we get into the result of the trade, let's first go through the thought process behind it. Starting from the daily time frame, there were two things that immediately stood out to me. The first one was this candle sweep. You can clearly see that price swept the previous candle's low and then closed back above it. And the second thing was this daily internal range liquidity sitting right here. My expectation became very straightforward. I expected price to remain bullish and continue pushing higher until it eventually reached the daily external range liquidity. So overall, my bias was bullish. Now, after getting that higher time frame bias, I headed down to the 4-hour time frame. And here, all I was looking for was a good point of interest where I could potentially frame a bullish trade from. And right here, we had this 4-hour internal range liquidity marked out on the chart. So my expectation was simple. I wanted price to retrace back into that 4-hour internal range liquidity and then continue pushing higher into the daily external range liquidity. So now that I had my bias and my point of interest, All I had to do was wait for price to come into the level and then look for an entry confirmation. As price moved into the 4-hour internal range liquidity, I dropped down to my entry time frame, which was the 1-hour chart. Now let's play price forward so you can see exactly what I saw at that moment. Right here, as price continued developing, one thing immediately caught my attention. Price created a lower low, but when I compared it with NZD/USD, I noticed something completely different. Instead of creating a lower low, NZD/USD was actually creating a higher low, and that is a clear SMT divergence. So now we had bullish higher time frame bias, a 4-hour internal range liquidity, and a 1-hour SMT divergence. After that SMT divergence formed, the next thing price gave us was a bullish 1-hour fair value gap. And that fair value gap became my entry. Now naturally my stop loss should have been placed directly below this swing low. But because I wanted to give the trade a little bit more breathing space, I decided to add an additional 5 pips beyond the swing point. So instead of using a stop loss of around 9 pips, I increased it to roughly 14 pips. And then, as always, I targeted a simple 1-to-2 risk-to-reward ratio. Now everything was set. The analysis was complete. The entry was taken. So let's play price forward and see how this trade eventually played out. Right here you can see price immediately started reacting. It came very, very close to my stop loss. In fact, if my stop loss had been placed directly at the swing low, this trade would have been stopped out. But because I gave the trade a little bit of room to breathe, price was able to complete the manipulation without taking me out. And shortly after that, price pushed aggressively higher and eventually hit my take profit. And this is exactly what I was talking about earlier in the video. Sometimes the difference between a winning trade and a losing trade is not your analysis. It's not your entry. It's simply your stop loss placement. Because if I had placed my stop loss directly at the swing low, this would have been recorded as a losing trade. Now let's move on to the next example, which will also be the final example of this video. So for this final example, as always, we are going to start from the daily time frame so we can understand exactly what we should be looking for on that specific day. Now right here, the first thing I can clearly see is that price is reacting from a daily internal range liquidity. And whenever price reacts from a daily internal range liquidity, the expectation is that it should seek out daily external range liquidity, which in this case is this low right here. So immediately my higher time frame bias became bearish. Now after getting my bias, I headed down to the 4-hour time frame. And just like in the previous example, my objective here is simply to find a good point of interest where I can frame a bearish trade from. So let's play price forward. Right here you can see that price leaves behind a 4-hour bearish internal range liquidity. And this immediately becomes a potential area where I can start looking for bearish opportunities. So now that I have my higher time frame bias and my point of interest, all I need to do is go down to my entry time frame and wait for confirmation. In this case, I went down to the 15-minute time frame. Now let's play price forward again and see what happened. The first thing that stood out to me was an SMT divergence. Right here, Euro USD created a higher high. But when we compare it with GBP USD, we notice something completely different. Instead of creating a higher high, GBP USD created more of a lower high. And that difference between the two pairs gave us an SMT divergence. Now going back to Euro USD, after getting that SMT divergence, the next thing price gave us was a bearish 15-minute fair value gap. And that fair value gap became my entry. Now naturally, my stop loss would have been placed directly above this swing high. But just like I explained earlier in the video, I wanted to give the trade enough room to breathe. So instead of placing the stop loss exactly at the swing point, I added an additional 5 pips beyond it, which brought the total stop loss to approximately 11.6 pips. After that, I simply targeted my usual 1-to-2 risk-to-reward ratio. Now everything was set. The bias was bearish. The order flow was bearish. The SMT divergence was there. The fair value gap was there. And the stop loss was properly positioned. So let's play price forward and see how the trade played out. Right here, you can see that price came extremely close to my stop loss. Very, very close. But eventually, price respected the setup and pushed directly into take profit. And this example perfectly illustrates the point I have been trying to make throughout this entire video. The analysis was correct. The bias was correct. The entry was correct. But if my stop loss had been placed too tightly, this trade could easily have become a loss. And this is exactly what happens to many traders every single day. Their analysis is correct. Their strategy is correct. But because their stop loss is too shallow, price takes them out before making the move they originally anticipated. And then they start blaming the strategy. They start changing systems. They start looking for a new mentor. When in reality, the problem might simply be their stop loss placement. So after watching this video, I want you to go back and review some of your previous trades. Look at the trades that stopped you out before moving in your direction. And ask yourself honestly, was the problem really the setup? Or was the problem where I placed my stop loss? Because sometimes that one adjustment alone can completely change your trading results. If this video was impactful to you, I'd love you to give it a thumbs up and subscribe. And I'll see you in the next one.